Hey guys, I'm going to be sharing with you guys my trading strategy. I trade pullback and I've been using it quite consistently, with a really high win rate, upwards of 70 to 80% win rate. So yeah, it's been quite good for me. I've done a lot of work. So yeah, enjoy. So before we get into it, you hear a lot of people talking about, for you to trade, you need to have an edge. You know, so what exactly is a trading edge, and how do you get an edge? So for me, a trading edge is essentially an edge, plain and simple, is basically the probability of one outcome occurring over another. Like if you have a queue on an event that indicates that one outcome is more likely than another outcome, then you have an edge, you know. And of course, it's a function of the probability and the size of the payout. It's not just the probability. So to have an edge, you need to have a positive expectancy. And what do I mean by that? So like the strategy we trade, the winning rate is upwards of 70 to 75%. So the thing is, if you have a system that wins, let's say 70% of the time, so 70% of the time you win, and 30% of the time you lose. So this probability alone is not enough to give you an edge. So the size of the payout also matters a lot. So if if you win in 70% and 70% of the time you win, let's say $30, you win $30 when you win, and when you lose, which is a minus, which is 30% of the time, you lose $70. So in this situation, you don't really have an edge. It's a game with where you don't really have an edge. You're not winning, you're not losing. You see, the outcome is zero. But if 70% of the time you are winning anything more than $30, and 30% of the time your losses stays the same, you are winning money. So that's how I view it. So whatever system you trade, you have to design it in such a way that either you have a high win rate, and preferably uh, the win amount is high also, and the win amount is also high enough compared to the probability of loss and the size of your loss. You know, if you can get this equation to be more than zero, you have an edge. Of course, you have to factor in the transaction cost and all those stuff. So with that out of the way, you know, getting a bias, that's another thing that I want to talk about. So in trading, we talked about having an edge. You need to have a systematic way of coming into a chart and deciding whether the probability of the move today, of the move we are expecting today, does it lie on the upside or does it lie on the downside? So you have to come in today and do your analysis, and I'm going to show you guys how I do this, and decide what's my bias for the day. Of course, you can have your bias, but also You can't come in blindly, with your bias and forget to pay attention to what the market is doing. At the same time, you really, really need to have a bias. And how do you get this bias? You get this bias by figuring out where the probability lies of a certain type of move. And I will show you guys how I do these things. But just keep these things in mind as we move forward. So trends and ranges on higher time frame. So what is a trend? Different people have their own way of describing a trend. Some people will say a higher high, higher lows, and some people will say we have a trend when we are closing above 200 moving averages. And others will say that you have a trend when we are above the 50 period moving averages. And all this might be correct. All this might be correct because this guy is saying this have probably done their own work in their own way, to figure this thing out or maybe to come to that conclusion. But I'm going to show you guys how I decide what a trend is. For me, let's go to a chart. Let me just open open a pound Canadian dollar chart. So let's get rid of all these indicators. So when I come to a chart, when you come to a chart, yeah, some people will define a trend as this series of higher highs and higher lows, and that's fine. That's okay. But for me, how I define a trend is if you have candles closing like this, you have a trend. I said that this is an uptrend. If you have candles closing like this, going down, this is a downtrend. This is an uptrend. And if you have candles closing like this on the side of each other, you have a range. This concept is so important. It's so important that you pay attention to this because it makes a big difference in whatever strategy you decide to trade. Yeah. So if candles are closing in this way above each other, lower lows, higher lows, higher highs, higher highs and higher lows, and lower. How do you say it? You have this candle closing, making higher highs and higher lows, and you have this one making lower highs and lower lows. So this is an uptrend, this is a downtrend. If the candles are closing beside each other, you have a consolidation. Yeah, you have a consolidation. So this is a consolidation. But of course, when we trade, we are always trading on multiple time frames. And you want to be deciding what the trend is on a higher time frame from the one you are trading. So if we are trading on 1 hour chart, you want to decide on what the trend is on the daily chart. Yeah. If you are trading the 4 hours chart, you want to be deciding what the trend is on the weekly chart. And if you are trading the 15 minutes chart, you want to be or 30 minutes chart, you want to be deciding what the trend is on the 4 hours chart. This is so important, guys. So important. So it's an important concept to keep in mind. I will show you what it looks like on the chart in a minute. So delete this. So let's take for an example. Look at this area in the chart. So This is the 1 hour chart. Yeah, this area that I highlighted. If you look closer to the candles, you see this candle came down here, pushed up. The next one came down, respected this low, pushed up. The same thing with this one, with this one, with this one. Yeah. Even with this one, with the last one, we broke the high, respected this low. So in my definition, you have an uptrend. But of course, not an uptrend on the 1 hour chart. If I'm looking at this, it means my trading time frame is something like the 5 minutes chart. So if we go down to the 5 minutes chart, you will see what that area I highlighted looks like. Let's see, where is it? Oh, just give me 1 second. I need to remove this indicator. Close hourly charts. Highlight this. Go to 5 minutes charts. What's this big yellow highlight? Remove this. Okay. So this is the price action I was talking about. It didn't quite highlight what I wanted to talk about. It's not as pronounced as I would have hoped, but nonetheless, you can see that we pushed up. This is a clear pullback. Pushed up, a pullback, pushed up, a small pullback, pushed up, pullback, and so on and so forth. So on a 5 minutes chart, that those price action on a 1 hour chart is more like a proper trend. And if I didn't tell you this is a 5 minutes chart, it could have been a long, maybe an intermediate trend on a particular instrument. We don't know. But that's the idea. If you look at a trend, for example, what currency pair is this? Pound card. Pound card. It haven't trended in some time. For example, look at this price action here. It's around 13th of December. Let's go to 1 hour chart. You see the same thing. Is just a series of, on a higher time frame, is just a series of bullish candles, you know, making higher highs and higher lows. That's what it is. On a lower time frame, it looks like a big trend. So you always use multiple time frame analysis. Where is it? 13th of December. Here. See what it looks like. Push up, pullbacks, push ups, pullbacks, push up, pullback until the higher time frame candles started closing like this. Probably somewhere here will be higher candles going up, and all of a sudden you have one closing down like that. That's when you get this move, and it signals a change of trend. So remove this. So that's my definition of a trend and trading ranges. Yeah. Why is this important? It's important because whatever strategy you trade have market conditions when it does really well. And it's important you know this. I don't care, no strategy works on every market condition. There are strategies that work well in a trending market and some work well in a ranging market. So you just have to figure out, whatever you are trying to do, under what market condition does it do well, you know, in terms of the pullback strategy. Pullback strategy works well when market is moving cleanly. If you have a market that is moving like this in a trend, clean trend, then the strategy just brings home the bacon. Once you enter a range, if the market conditions start doing this, if price action starts going into this, you'll still get the pullback signal, but it's not gonna work. It's not gonna work as well. And I will explain to you guys, why it doesn't work as well. Basically, every market moves up and down like this. And the strategy you try to employ is different when we are making higher highs and higher lows compared to when market is not going anywhere. It's going sideways. So it's something to keep in mind. So for pullback strategy, you want to be trading it in a trend, in a trending market. We are making higher highs, higher lows on a higher time frame. That's when you are deploying the strategy. So what is a pullback strategy? So a pullback strategy basically is a strategy that tries to exploit the way a market moves. You see, if price is going to go from $10 to $20, it will never get there in a straight line. It never gets there in a straight line. So what you have is price will move up, pause, goes down a little bit, then it continues to move up. If you look at this area of a chart, you can see we moved from here to here, from the bottom of the screen to the top of the screen. But how did we get there? Pushed up, we paused, pushed up again, retraced all the way here, push up, came down, and that's not how this is. If you look at any market, this is how market moves. It will never be a straight line. It's just a series of a push pull. You push up, you retrace, you continue the up move. See, this is how price moves. So market will never ever just shoot up in a straight line. You push up, then you retrace. And what is a pullback strategy? A pullback strategy basically is trying to take advantage of these counter moves. Of course, we are in a pullback strategy. We are trading in a trending market. So the idea is that we have a push it in one direction. That when we retrace, the move will continue in the original direction. Yeah. So that's the idea. So you get all these pullbacks in a trend. This is what we are trying to exploit. In theory, that's what we are trying to exploit. Of course, going about this in practical term with real money, trying to exploit these things profitably, it's a different matter. It's not as straightforward as you see it in hindsight. But I've done a lot of work in this area, and I've figured out a way to trade it profitably. And if you stick to the end of this video series, that's what I'm going to be sharing with you guys. So you have this, and that's it. So these are what we are trying to exploit. So when you are trying a trend, when you're trading a trend, basically, when we have the push phase, we are looking for a pullback and we are buying this pullback. We have a push phase come down, we are buying somewhere here in the hope that market will continue up, and that's what a pullback strategy is. So when market is in a trend, it doesn't go up in a straight line. Yeah. So exactly, you're trying to buy retracement in a trend, expecting the trend to continue. So the other book. So why should a price move? Why do price move up? Why do price move up and down? Let me show you what another book looks like. Uh, Let me show you what another book looks like. I mean, some of you probably have seen another book, but some of you just maybe haven't seen it. But I will just give you an example. I think I downloaded something from the internet. Where is it? Where is it? Where is it? Here and here. So this is what another book looks like. So these are stacks of buys and sell orders. Uh, Hang on. I'll just open this in Paint. So zoom in. Okay. Oh, it's annoying. Zoom out a little bit. Come down. So this is the price of a Bitcoin. I got this from the internet. So the data come from bitfinex.com, I believe. Came from bitfinex.com. So guys, so imagine. So this is what another book looks like in most markets. In most market, this is what another book looks like. So you have the current market price right here, current Bitcoin price. Then you have the sell orders above the market. You have the buy orders below the market. Here you have the quantities, the buy quantity. Here you have up here you have the sell quantities, and this is the depth, other book depth. You know, so this is the other book depth. So you have the bid prices, you have the ask prices. Yeah. So how does price move? So for price to move up, and for price to move up, you have to have an aggressive buyer. This is so important. You must have an aggressive buyer willing to push prices higher. Yeah. So what happens is that if this guy have 100 lots, let's say 100 lots to buy, to fill this order, yeah, he doesn't have to do anything. Yeah, he can just wait and buy at the current ask price. Yeah. So he can wait. This guy only have two to sell. If this guy steps down in price, he buy the two. No problem. He waits again. Somebody else steps down in price, he buys from more. But what happens is that most time in the market, yeah, especially at market opens, probably have a bunch of institutions with big volume of orders to transact quickly. So there is a big urgency to get the orders done. Yeah. Sometimes something might have happened the previous day and people are anxious to get to the market to either get rid of their position or increase their position depending on what the information is. Whatever the reason, yeah. For price to move up, imagine a candle. How does a candle form? A candle opens, it's like this. For price to move up, literally this guy, if this guy is wants to get this 100 lots quickly and he believes there he have a reason to believe that the fair price of this asset is probably somewhere up here. Yeah. A candle will open, push up, push up. This guy with 100 lots will go in, take out all these orders. Buy this guy at the market. The guy is selling at 590 at the market, at the market, at the market, until this 100 lot is filled. Yeah. So imagine if he takes out all these sellers up until here. Let's say up until here. And he doesn't want to push price up anymore. He will wait. And when he waits, price will start to come down a little bit. When it comes down where he believes is okay, he will go in and transact the rest of his, take out the rest of his orders. So you have a huge candle. But if this guy never stepped up to start taking out all these sales, price is not going to move. If you don't have an aggressive buyer, there is no movement in price. It's as simple as that. It's as simple as that. So for price to move, you have to have aggressive buyers and aggressive sellers. Oh shit. You know, aggressive buyers and aggressive sellers. As simple as that. The same for price to go down. For price to go down, an aggressive seller have to come in, yeah, and take out all the buy orders here, all the bids. Came in maybe with 200 lots, take out the 0.5, 4, 6, 12, 2. If he doesn't feel anything, you have a huge red candle like this, comes up, maybe came down all the way here, pull back, and maybe close somewhere here just with a small wick. If you don't have an aggressive buyer or aggressive seller, nothing happens in the market. The market just stays the same. It just stays where it is. You don't get movement. So this is important. This is so important. So if there are no aggressive buyers or aggressive sellers, what happens? What you have is market will open somewhere here. The candle opens. Maybe it goes up a tiny bit because market participants believe this price is fair. So there is no reason to move anything. You have a candle that looks like this, a small wick on the top, a small wick on the bottom. The hours goes by or the minutes go by, you keep getting something like this. So most of the transactions are happening at the bid or as close as possible to the bid and ask. You just get a bunch of small candles, so there's no movement. There's no movement. So what does this mean? To get a trend, to have candles making high highs and low, you have to have market participants who have urgency, to get their transactions done, and they keep taking out for price to go up. They keep taking out the ask above the market, and for price to go down, they keep smacking the bid. You hear about the term "hit the bid." That's what it means. I mean, hit the bid means to sell out the market very much. Yeah. For price to go down, these guys are not gonna sit around waiting for this bid and ask. They just go down aggressively, take out all these things, and this is what moves the price. So you have an uptrend. For an uptrend to occur, you have to have guys who are buying aggressively. For a downtrend to occur, you have to have guys who are selling aggressively. And when we have a range, you don't have market participants who believe. Let's say you have market participants who believe the current price is fair, so there is no reason to move price. They don't have urgency. They believe the current market price is fair, and they transact as close to the current bid and ask as possible. So you get a bunch of candles like this. So why is this important? So in a market, price primarily move in an uptrend, in a downtrend, or is consolidating. Yeah. And remember what I said in the beginning of the video. Not in the beginning, but in the slide where I was talking about the market condition that is most suitable for a pullback strategy. So when you're trading a pullback, you want to be trading it in an uptrend. In a downtrend, you never trade it in a ranging market. You get killed. Yeah, you get killed. You will get the signals, but you will get killed. So this is a very important concept about other book. Yeah. So that's how price moves. If a trend to occur, you have aggressive buyers and sellers. Change in perceived value of the asset. Range, non-aggressive buyers and sellers. Current price is fair. It's as simple as that. Very, very important piece of information right here, guys. So the edge we are trying to exploit when we trade a pullback strategy. So what is the edge? Why should this strategy work? Why does it work? Yeah, why should it work? So basically, the strategy works because what happens is that when you get a huge candle, a big candle that is outside of normal, yeah, let's say it has a wick here to the top. This is a bullish candle. Through my work, something like 70 to 80% of the time, when the next candle opens here, it will test the high of this candle, this high right here. A new candle opens, it will push up at least and test this high right here around, let's say, 75% of the time. 75% of the time. 75% of the time. We have a strong push. You have an aggressive buyers that stepped into the market. Take out all these ask, maybe they push it up to here. They believe that price have gone far. Of course, most people nobody wants to pay too much. Push it up, stopped buying, the price will roll over a little bit. When the price rolls over, most of the time, if they haven't finished, let's say they have 100 lots to buy. If they didn't get the 100 lot in, maybe they bought maybe 70 lots up to here, and they stopped buying because, man, they've pushed price already a bit high. Maybe they're waiting for price to roll over a little bit to fill the next 30 lots. When the new candle opens, they will continue buying aggressively. And most of the time, this new candle will break the high of this candle, 75% to 80% of the time. And remember what I said. What's a trend? A trend is this, and these are the pullbacks in a trend. See, we rallied, pulled back, and that's exactly what we are exploiting right here for the pullback to continue to go up. And the opposite is true for a downtrend. So when we get a strong push in a particular direction, 75% of the time this high will be hit. And why should it be hit? Because when we get a candle that is larger than normal, a candle that shows aggressive buying, that shows a lot of momentum, yeah. In a chart, when you look at a chart, you have the big candles, normal candles, and aggressive candles. candle and candles that are really really big, and this is what we are hunting. Yeah, here you have all the small candles. Boom, you get this big candle showing that somebody with real money and real transactions to do have stepped into the market. And what happened? Once you get that, once you get that, they're bought up to here, they stopped buying, price rolled over a little bit, and we continue to go up. Price rolled down, and we continue to go up. We roll down, keep pushing up. But the thing is, you see that most of the time, this high, the high of these candles are taken out. You see this high, taken out, this high, taken out, this high, taken out. Even this high was taken out. This high was taken out. So what does this look like on a lower time frame? Let's go to 1 minute chart, for example. How's this thing doing? Okay, so this is 1 minute chart. You can see what it looks like. I mean, of course, I don't trade the 1 minute, but just for illustration purposes, the moves are more pronounced on the 1 minute chart. So you have a candle moved up, pull back. This is the pullback. Moved up, pull back, continue up, pull back, continue up, pull back, continue up, pull back, continue up. So the move is never going to happen in a straight line from here all the way to here. It's a series of up push, we pull back. But you have to notice that we are never breaking the low of the push. Whenever we push, the low of the push is always respected. Pushed again, pull back, respected, respecting this low. Pull back, push up, we are respecting this low. Then we have this final long push. On the higher time frame, this is what it looks like. It looks like I showed you before. See, a push, we pull back, a push, pull back, push, pull back, push, pull back, up until here. So this is what a pullback looks like, and that's the edge we are betting on. We are betting on when we have a strong push in a particular direction, up or down, and price retraces 70 to 80% of the time. The high or the low of the initial push will be broken. Of course, this depends on the time of the day. Time of the day slash session. This brings me to another important topic. In trading, you have to pick you have to pick the time you trade carefully, because most trading strategies, most people who are struggling, most likely your strategy is okay, but you are trying to apply that strategy in a market environment where there is no volatility. You see, to make money in the market, there has to be volatility. No volatility, no money. If the market is not moving, no money. If the market is not moving, you buy something, it rolls over, because you don't have those aggressive buyers and sellers willing to push price up. If you buy something, nobody else is willing to push price higher from where you bought it from, you don't make any money. It's as simple as that. Yeah. So time of the day is so important. It's so, 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 so important. And what time of the day should you be trading? Always at major market opening times. Yeah. So in Forex, for example, the major opening time zones are the Tokyo, the Japan slash Australian time. Then you have the London time, London session. Then you have the New York session. So at these times of the day, that's when you should be looking for trades. Everything works so much better around those times. Yeah. So when you are looking for a pullback strategy, if you have a strong push outside of this area, chances are What pushed up those price? You don't have a lot of strong enough players to put, to continue pushing price in the direction you were hoping for. So most of the time, when you get those push outside of those market hours, you get those push, you buy them hoping for price to continue, it just rolls over and hits your stop loss. So it's best to stick to major market opening hours. This is so important. Pullbacks in a trend. So what does it look like? Strong push, we pull back, we taking the trade down. We get a push, pull back, we taking this pullback for price to continue moving up. Pull back, taking buys for price to continue moving up. Pull back, taking the trade for price to continue moving up. So multiple time frame analysis. Time frame sequence, day, the daily time frame. So when I'm trading, when you are trading, you have to use multiple time frame analysis. I've talked about the trend, and you always want to define the trend on a time frame higher than the one you are trading. Like for me, I trade predominantly 1 hour chart. Yeah, I've traded 1 hour chart for a long time, but recently I've been trading 5 minutes chart. But so for me, the sequence, it doesn't really matter the time frame you trade, but you have to have your trading time frame. Then you need your higher time frame in order to get your bias and decide what the trend is. Yeah. So if you are trading the 1 hour chart, you want to be getting your bias on the daily chart and maybe refining your entry on the 5 minutes chart. Like the third time frame is not really super necessary. Yeah. But you can use it, but having a higher time frame and a trading time frame is it can be enough. Use the higher time frame to define what the trend is. Are you trending or in a range? That's what you're looking at in a higher time frame. Remember what I said before? A trend and a range. So if you look at your higher time frame, you have to decide, is the candle doing this or are the candles doing this? This is so important. Yeah. If the candles are closing like this, it's way different than if the candles are closing right like this. If the candles are closing like this, you don't want to employ this strategy. So the first thing you do, you open up your chart, you look at your higher time frame, and what's your bias? Are we doing this? If we are doing this, we don't really have a bias. You can't do anything. If we are doing this, okay, so you have a bias. You know that most likely, you know, price will at least go to test this high. So we have a thesis for it there because we have a strong push in a particular direction. We already know from our work that when next candle opens, it will open here. Opens here, yeah. When it opens here on a higher time frame, 75 to 80% of the time, it will go up and at least test this high before it either goes down or continue to break down. But most of the time, this is what happens. So this is how you get a bias. Are we in a range? Are we in a trend? Yes or no? Are we in a range? We can't trade pullback. There are other strategies to employ when we are in a range, but that's another topic. But if we are in a trend, we are making candles are closing like this, then you are looking that and price have opened here. The thing is, the probability of price going to test this low versus going up to test this high. To test this high, you are looking at 70 to 80% probability. To test this low without testing this high first, even with testing this high, if we hit this high, the probability of testing this low and breaking it goes even way down. If we hit this high, the probability of price going down to test this low is like 4%. So 96% of the time, it's not going to happen. Yeah. But if we haven't breaked either side, then you have a 10% chance of price going down to break this low, and a 70 to 80% chance that this high will be broken. Then you have something like 25 to 30% chance that price will never hit this high or hit this low. It will close something like this, never testing the high and never testing the low. So this is how you get your bias. This is how you decide what direction you need to trade. This is so important. So you are doing this on your higher time frame. So if you are trading the 1 hour chart, you're looking at daily to get this bias, or to pick a direction you want to be trading in. If you are trading, if you are trading on the 4 hours chart, you use your weekly chart to get a bias. Yeah. If you are trading the 30-minute chart, you use your 4 hours to get your bias, to decide what the trend is, to decide what direction you want to be trading. Yeah? So what you don't want to do is, I mean, what you don't want to do is to have a higher time frame closing like this. If you have a higher time frame candle like this and the next day opens, trust me, you will get signals sometimes when this starts to go down like this. You will get signals to go short. Yeah. But remember what we talked about in the other book. So the big players, most of the time when they push price up, if they push it high enough that it's become maybe too expensive for them to buy at those higher prices, they will stop buying, hoping for price to roll over to a price they consider okay for them to step back in again. And remember, we opened somewhere here, the new candle, they have stopped buying. I mean, the big players. So price will roll back down until it's gone down enough to what they consider a good price to step back in to fill the rest of their orders. So the thing is, when we are here going down on lower time frame, remember this is a higher time frame. On lower time frame, you will be getting all sorts of signals that market is reversing and heading down. You will be getting pin bars indicating a downward selling pressure. You will be getting an engulfing candles showing that the market is about to roll over. But what happens most of the time is market will come down a little bit. You will be thinking that price is going to go down. And what happens? The aggressive buyers will step in again. You get a huge push. Boom. Just like that. Taking out the high, taking out all the stop loss for people who went in short. Yeah. And you get a close like this. So my point is higher time frame analysis is so important. Yeah. If you have a strong candle in a higher time frame, you never want to trade against those candles. In unlikely situation where you decide to do these things, you have to be super aggressive with your take profit. You never try to hit a home run going against those candles. It has to be quick in and out. You go in, you go. Let's say you have a strong bullish candle on your higher time frame. If you're gonna trade against that, which I highly discourage, if you're gonna go against that, go in, take whatever you can grab and run. Yeah. So and yeah, this idea is so important. So higher time frame candles, higher time frame for deciding getting an edge and getting a bias, and you have your trading time frame. So how candle form? How candle forms? So guys, remember when you get these things, if you get something like this candle, if you get moves like this, what do you think? What do you think this type of formations look like on a lower time frame? This things. If you're getting things like this, if you're getting, it's so important to pay attention to distance. Have distance. Have the candles like this. Anyway, I've showed you guys this thing before. Why it's so important to keep this in mind. You remember when I showed you guys, you know, here is the same idea. When you have candles pushing up, these are pullbacks. These are trends on a lower time frame. See, these are lower highs and higher highs and lower lows. Something like this on a lower time frame will probably look like probably. I'll just make it easy, man. It will probably look like this. We have a move up, which is the first candle. Pull back down, move up, pull back down, and we move up again. It's a clear trend on a lower time frame. See, something like this on a daily chart. On a 1 hour chart, it will look like this. Yeah, and I will open up a maybe a daily chart of pound. Let's say pound US. Pound US. The last couple of days have been moving quite a lot. So let's say pound US. Get rid of all this. Get rid of all this. Uh, delete this. Delete this. Delete this. Okay. So look. Let's have a look at this move. This we pushed up, came down, pushed up, came down. What do you think this looks like on a daily chart? So this is the last one, two, three, the last 4 days. What does this look like on a daily chart? So something like this. Probably three daily candles showing high highs and retracements and lower lows. So exactly. See? It's so important to understand how candles move. See? A push, pull back, a push, a pull back, a push. Yeah. So what you don't want to be doing, what I was talking about before, when we have these strong moves, we have this strong move and we are pulling back. Sometimes you will get a sell signal, but you don't want to be taking these sales. You might even use these pullback opportunities to enter in the direction of the momentum candle with the big boys, which is what we are exploiting anyway. That's what we are doing. Yeah. So this is what you want to be doing. You get a strong push. You never want to be trading against that. You never want to be trading against that. So yeah, I've talked about higher time frame, get a bias, decide the game you want to play, and know the statistic for that particular game. So the thing is, if you're trading pullback, you have to know whatever strategy you decide to play. Don't take it from me. Whatever I'm saying in this video, don't take it from me. You go do your work, do your statistical work, and see if the if the edges are there. Are the probabilities on your side in trading that particular setup. So you decide the game you want to play. I can tell you all this. If you don't do your own work, you probably won't have the confidence. I can show you what I do and everything, but you still have to do the work to have the confidence, to follow it. So, yeah. So time frame sequence, how candle form, high time frame, get a bias. You get your bias, high time frame, the game you're trying to play. Low time frame is where you find your trades, trading time frame, you find your entries, trade with high time frame candle direction. This is so important. So where different players, high time frame and low time frame, perceive value. So this is I mean, it comes down to what I was talking about before, about trading against higher time frame momentum candle. Yeah. So higher time frame guys find value if price goes up in a particular direction. Yeah. Most of the time when it goes up this high, they wouldn't keep buying. They wouldn't just keep taking buys and for this price to go to the moon. Most of the time they will buy, price will start pulling back. If we look at this, if we look at all these pullbacks, probably, man, lower time frame players would have probably found opportunities to go short. If you look at this, these are pin bars, these are pin bars, these are our reversal signals. You have this formation. If you really think about this, if you go to a low enough time frame, this is a range. People employ different types of strategy. So if you go to a low enough time frame, there is this. What you are looking at here is a range. So we had a range right here, and people who are trading breakout on a lower time frame, when this happened, would have taken the trade, not realizing that you know higher time frame players will be finding values right there. They've pushed price up, pulled back, they will be stepping in to buy. So if you're trading a breakout, hoping that the price will continue to go down, man, you got burned. You see how fast price pushed up. So the same thing, when we pushed up here, some people would have considered this an engulfing candle to go short because price have gone up a lot. But if you are doing this, you're gonna be struggling a lot because price pushed up, consolidated. You can call it a pull back a little bit. Then look at how fast it exploded. Then you have these three candle formations. I mean, if you took it, it would have been you would have, it wouldn't be it's not an easy trade. True, if you took this trade right here going short, price came down, pulled back up. Man, look at the strength of this push, taking out all the stop losses here. So going against higher time frame momentum candle, it's painful. It's better to go with it instead of against it. Lower time frame guys might find signals going counter to those high time frame momentum candles. But if you can avoid it, trading against them, avoid them. Avoid them. So these are charts of a pullback setup, and these are the statistical work I've done that shows where the edges lie. So when we get those candles, you see the areas I highlighted yellow. When we get a big candle that is larger than normal, and the body of the candle fills up about 60% of the ATR, meaning the candle's range. Yeah. For different currencies. So this is a 60 minutes. This is a 60 minutes time frame. You have Australian dollar, Euro US, Pound US, US yen, US card, Pound New Zealand, and Pound yen. Yeah. So for Australian dollar, what's considered a big move on a 1 hour chart is 11 pips. For Euro US, 13 pips. Pound US, 15 pips. US yen, 12 pips. US card, 12 pips. Pound New Zealand, 28 pips. And Pound yen, 22 pips. Yeah. So for pound yen, when we get a 22 pips move on a 1 hour chart and we get those pullback, if it's a bullish candle, 76% of the time, the next candle will test the high of the previous candle. And if it's a bearish candle, it's about the same, 75%. And the probability of the next candle breaking the low of those momentum candle is around 8 to 9%. So you can see that the odds, the bias, the probability favors going with the momentum. Yeah. Of course, how much you win when it hits the high versus how much you lose when these lows are hit. These are totally separate topic. But this shows you the statistical edges where they lie. So 75%, the highest hit for pound yen, pound NZ, 77%. They are roughly about the same, above 70%. So it's something to keep in mind. So types of pullback, stop loss, profit target. So I will take a break, and when I come back, I will continue with this topic. Can I pause this? I will. Okay, guys, I'm gonna end this video right here. Then on our next video, I will talk about types of pullback because talking about these ideas in hindsight is one thing. Yeah, trying to implement them in a live market is very challenging. But I've done the work, so I will make the whole process, of trading this setup a lot easier for you guys. You know, so when I come back, I will on my next video I will be discussing about the types of pullback. Because pullback is not uh, like any other thing. I can show you everything on the chart, but in live market, it's not gonna unfold exactly the way I show you. So in this particular strategy, how they unfold in chart are what I call these types of pullback. So I will be talking about them. You have the simple pullback, you have the complex pullback, then you have pullback to a support and resistance zone, then you have a pullback to Fibonacci levels. Yeah. So on my next videos, I will be talking about these ideas. Okay, guys. Thank you.